Welcome back to the Finanzfeuer Talk. Joining us are Altopo
Hi everyone, Octopo 5 here.
and MB Capital Strategies. Today we're talking about timing versus buy and hold. A quick opening remark. You don't have to time the market perfectly, but you should understand when and at what price you're actually buying the market. Let's start with the general fundamental question. What does beating the market even mean? Beating the market means achieving a higher return after costs and taxes than the benchmark index, such as the DAX or S&P. And doing so consistently, not just by luck. And that's actually more precise than it sounds.
Yeah, well, people like to talk about the benchmark they set for themselves. Typically, or the typical benchmarks people set are MSCI World or S&P 500. Those are basically the standard indices that are broadly diversified, which also have pretty good average performance. For the MSCI World, you're talking about an average of 8% return per year, and for the S&P 500, up to 10% return per year on average. And those are the classics that everyone invests in. And if there are people who think they can do better, then usually these exact standard indices are used as a benchmark. And beating the market means that you use that as a guide when building your own portfolio. So you're always comparing your own performance with these standard indices, the so-called benchmarks, to then be able to prove whether you were actually better or just bluffed too much and in the end nothing came of it.
Exactly. And over what period of time would you measure all of that? Well, I'd say that 1 year has relatively little significance because you can always get lucky with a stock, for example.
That's absolutely right. That's exactly what you have to watch out for. And that's also where you always see so much fake advertising on the internet, where they always say, oh, look here, within a few days, the stock just exploded by 100%. That's why it's the best strategy and why you should maybe, the drill, invest in cannabis stocks or hydrogen stocks just because it somehow went quite well over the last 1 or 2 weeks. No. So it's always important to look at the long-term period of such an investment strategy to really see if it was just a lucky shot for one day, or if it's actually a long-term strategy. That applies to every investment product you look at, or even to individually constructed stock portfolios. Even when you look at influencers or finfluencers, as they're often called, and see what they're showing, they're supposedly good stock strategies. There too, you always have to look long term over at least 5 years, I'd say, if not even 10-year periods to really check it out. Are the people who actually claim that they can achieve such an incredible performance, have they just been lucky with their stock selection, or is it truly sustainable? Also a very good strategy compared to the classics, like an MSCI World or S&P 500. Therefore, always be careful in the short term. That can always distort the picture a bit because in the short term, with luck, you can always achieve really big outperformance. But you don't just want to be lucky once and then lose everything again if a certain industry collapses, but you want to build up a lot of growth in the long term. Exactly. And how do you see it? Can you agree with me there?
Yes, I definitely agree with you there. That means what you just described was that typical Lambo group. Yeah, I made 100% in a week or something. And that with what feels like two trades, I'd rather not show you the other 10. Exactly. I mean, of course not. Everyone always has an investment horizon of 3 to 5 years. I, for my part, for example, have only been at it for about 3 to 4 years now. That means I don't really have the proof yet, let's say, the proof of concept. But what I'm doing right now, I would say, is definitely going in the right direction. But sure, for a complete, truly data-based strategy, you need a bit more time, I'd say. Exactly, but I would also absolutely agree with you. The only thing I would like to add would be, of course, many who also finally include transaction costs and also the spreads and also, of course, custody fees, because you have to take those into account ultimately. And there are actually enough tools that can track and record all of that. Or most brokers actually already do that very, very well, I would say. Otherwise, from my side, I wouldn't have anything else. Algotopo, if you don't have anything else either, I'd move on to the next chapters.
Gladly.
Exactly. So we're at the next chapter, which would be buy and hold, why it works. I would just briefly add, and for whom it might also work and be more feasible. Exactly. So here we have, for example, who it's better for. Of course, you always have to differentiate the investment perspective for each person. There are people who simply have less time to do extensive research or to develop a strategy, let's say. Here, it might also make sense, among other things, to simply mirror a large, broad index, perhaps, because then you have your 8% a year in very, very good years, let's say 30. In bad, really bad ones, you might have minus 50%, but on average, you have about between 8 and 10%. And if you really don't want to deal with the topic, then in my opinion, that's definitely the better option instead of being active accordingly. That means you simply have no daily decisions. You don't have to read through quarterly reports extensively. Yeah, and you always end up having a longer upward trend as well. That would be roughly the whole situation. And you still benefit from the whole compound interest effect.
I completely agree with you there. So I think the biggest advantage, and that's why I do it for the most part with my own portfolio, is the simplicity. Just invest ideally with regular savings plans, and then you just let it run. And then you don't have to stress about it. Oh, like the current situation in Iran, if we look at that, we'd have to drive ourselves crazy again. Oh, which stock should I maybe sell, and how do I maybe switch from one sector to the next? And then you fluctuate back and forth, and yeah, maybe make way too many mistakes in the short term in such a stressful situation. That's why this buy and hold is quite simple. You invest, and it's best not to look at the portfolio at all, especially in difficult situations. In the stock market, you just leave it there and wait it out. And a long-term upward trend, you can see it from the MSCI World. That's an index where you can look at a history that goes way back into the past. And if you look at it, you've simply always made long-term returns, no matter when you actually got in. As long as you wait long enough, then even the worst crisis eventually disappears completely. And you're almost certain to reach the profit zone sooner or later. And with these standard 7 to 10% average returns for the MSCI World, it must be said that's just the average. Every now and then you have even fat returns in a specific year when there's a strong upward trend. So that's just the average return. There are stronger years, but of course also weaker years. That means you shouldn't just say, oh, that's only 7 to 10%. So if you're in during the right years in an MSCI World, in a broadly diversified ETF, then you'll eventually have those years where you can achieve real outperformance in a single year. That's obviously possible there too. And the compound interest effect, you naturally like to take that with you when you invest long term and just leave it. But I think what's important with the buy and hold strategy, and this must be added, is that you really invest in a broadly diversified way and not in individual stocks, and then just wait. Because with buy and hold, it's really important to have a broad diversification and not just bet on individual titles, because a buy and hold strategy works best through a diversified portfolio. With individual titles, you really have to look more closely and then react if an individual title perhaps gets into economic trouble.
Exactly, completely correct. What I would also briefly add to that is, well, it obviously depends on what kind of investor you ultimately are. Or I'll put it this way, here it might also depend a bit on the mindset in the end. There are also people who, when a stock drops by 10% or something like that, simply react very quickly. Well, let's say critically, or maybe even overreact, meaning they just quickly sell the position, even though the position is actually quite good, simply because they can't stand to see those numbers. So here too, with buy and hold, for example, it's about saying just once, yeah, I know, okay, there's a bad year in there, but the coming years, they will definitely make up for it completely and double it and so on. That's just a classic mindset thing, I'll just say, that many people simply can't handle, whether it's buy and hold or maybe individual investments. With an individual investment, it's obviously much more extreme than, of course, when you're invested in a broad index.
Yeah, true. You're right. So with individual stocks, there are of course those stocks, especially, but then you're really talking about solid companies where you can actually apply this buy and hold strategy quite well. But you still have to be a bit more careful. You always have to keep an eye on the financial results because, for example, to name one, the VW stock. So VW was a German car manufacturer. I have no idea if that's a stock where you should apply a buy and hold strategy when you look at the political and economic situation in Germany and for the automotive industry. That's just a perfect example where you see whether a buy and hold strategy really makes sense for solid companies or whether you shouldn't, after all, read up a bit on the economic situation, on the situation for such companies. It's exactly the same with the chemical industry in Germany. The question is also whether it's even future proof to apply a buy and hold strategy to something like that. It can also be dangerous sometimes. But the important thing, what I wanted to say, is definitely focus on individual stocks with a buy and hold strategy, definitely more on solid stock titles and less on stock titles from the small cap or smaller business sectors where there's even more risk that such a company could go insolvent more quickly if the market situation changes completely and companies get into massive trouble as a result. You have to take that into account, of course.
Exactly. And there are, of course, also the weaknesses of buy and hold. And those are also, among others, the ones we briefly mentioned before. There are, of course, also maximum drawdowns of up to 50%. We saw that, for example, in 2008 and also 2009. In general, we also had long periods of sideways movement for the S&P between 2000 and 2013. Yes, and large drawdowns of 30 to 50% are simply a historical reality and not the exception. If you don't sell in time, you just have to sit it out or endure it. That's not a problem, of course, because you're designed to ultimately just sit it out more. In the next 2 years, the whole issue will be over and done with. But here too, you could, of course, act differently. Exactly.
Yes, what's important is the psychological part, which is hard actually buying stocks during a crash. Most people just don't dare to do that. And yet, those are exactly the moments when you can make the biggest profits. But the difficulty there is that you also have to find the right stocks in such a crash situation and not the ones where you catch a falling knife, where it actually goes down even further after the crash. That's also something that is very tricky. And exactly, yes, and the possible drawdowns you already mentioned that things can go down sometimes. And that's also particularly intense. So you have to think about not losing control and not letting it drive you crazy by something like that. Buy and hold really means sitting it out. No matter how low it goes, you just wait long enough and ideally drink a coffee and don't even look at your portfolio during that time. When the numbers in your portfolio are deep red in your own portfolio, and you really have to stay true to the strategy and really wait until the numbers turn positive again. Historically speaking, if you wait long enough, then eventually the green numbers will return to your portfolio.
Yes. What I also want to say briefly is that I see this with individual stocks, but I think it's ultimately no different with a broad index. Especially when you think, okay, I bought this stock very cheaply, let's say at a 52-week low. It could also be the index, it doesn't matter. And then so much news ultimately comes in that is even more negative than it was before. I wouldn't let that drive me crazy if you've already told yourself, okay, in my eyes, this is a good target to enter or to buy more. Then that's it. You did it based on something and not because some news is downplaying everything and talking it all down, so to speak. It's usually even a good sign that it might actually go up again just to shake out the so-called weak hands. Ultimately, let's just say.
With the buy and hold strategy, you can view the stock market a bit like a rubber band. Typically, you have, generally speaking, a middle ground where, on average, the portfolio's progress grows exponentially. And then surreal, the stock portfolio just fluctuates, up and down all the time. And the further down it goes, the stronger the potential is for the value to snap back up, just like a rubber band. Then it's exactly the same in the other direction. The more a portfolio's price goes up, the greater the possibility that it might also crash back down. So, like a rubber band, if you stretch it too far, the potential is high that the rubber band will snap back together even harder.
Yes, that was definitely a very, very nice example. It really fits very, very well in this case. Yes.
Yes. And that's why, for example, in today's situation with the war in Iran, it can also give a little bit of hope. Again, anyone looking at their portfolio now is probably a bit frustrated, which is naturally the same for me. That's why you have to visualize this rubber band comparison so you can look forward even more to buying at a low price now, and with the hope that there will then be a quick push back upwards. It is, of course, you can't know 100%, but historically speaking, it has actually always worked that way.
Perfect. And that actually brings us to the next topic, which is timing and what that really means as well. So, timing is not the same as day trading. Timing means proactively observing valuations, cycles, and the market and coordinating entry and allocation accordingly. It's not an all or nothing, so to speak. So timing isn't just daily trading, reading charts, and short-term betting, or predicting the perfect point, but timing is valuation, cycle, and macro analysis. Where are the potential weak points? Which stock is currently trading at its 52-week low? Was it perhaps the entire sector, or is it just that one specific stock? That can happen too. What's also always quite good is, for example, using cash as a strategic tool. I like to have a benchmark of 10% in cash, especially when you know that a lot has already gone very well. If we're seeing rock bottom levels everywhere, then you can, of course, reduce that a bit, because ultimately you use that cash to secure favorable entry points and to actively manage the allocation so that we don't have any stock, etc., simply overweight. And where would timing ultimately make sense? I'll just hand it over to Octopo here.
Yes, maybe generally about timing again. Well, you're absolutely right. I get the impression that most people just think of day trading when it comes to timing, like sitting down today, analyzing the charts for a bit, and then somehow thinking you're the greatest and then just gamble around. I mean, really in the sense of gambling. And as you rightly say, I wanted to emphasize that again. Timing really means in advance, and that can sometimes take a week or maybe even a month, or actually you do it anyway. Then you look at the stock market over one, two, or even a longer period of time, and analyze it over several years to get a good feel for where we currently stand, so that you really evaluate, look at the cycles, and understand how they emerge over the years in different industries, and that you really look at the macro situation in detail. So really, you engage with the stock market. It's not just like a lottery game where you just say, okay, Nvidia sounds exciting by name. Somehow everyone is talking about it, so I'll just put 5,000 on everything on Nvidia. That sounds more like roulette and not like professional market timing. But market timing really involves preparation, and preparation is the be all and end all here. That's just particularly important. Exactly. Where does that make sense? I think where that makes sense is really in specific sectors. When you look at sectors and also look a bit at how the industry rotations look, then we were able to see that quite well at the beginning of the year, for example. You noticed that towards the end of last year, there was already this fear of the AI bubble again, and also the market had priced in a bit that AI will make software companies redundant. And what you then saw was precisely this transition from the sector IT and IT technology towards value stocks. And that was exactly this change that took place extremely strongly at the beginning of the year. And I think everyone who had something in the technology sector in their portfolio and with growth and value stocks probably saw it that way, that this shift took place, that especially at the beginning of the year, these value stocks suddenly had gained very well, which had actually weakened a bit in the years before, while the information technology IT industry had really boomed in recent years and was actually quite weak at the beginning of this year. And that's a good example where you can see this sector rotation. And if you understand something like that, of course, and also notice early on that such a fear like an AI bubble arises, and that people are increasingly looking for a safe haven, so that you carry out the sector rotation yourself early on in order to be able to profit maximally from such a market rotation when everyone then shifts their assets. Exactly. Marco, where do you see timing as being most useful? Do you perhaps have another example?
Yes. So, for example, you can often see it in commodity cycles, or what I can also include here now is silver, for instance. Silver was a classic example. It felt like it was at rock bottom for 3 years at around 20 US dollars and so on. And then all of a sudden it saw a rise and was somehow catapulted upwards so quickly. That was somehow also, I'd say, quite a special event. We always knew that silver was somehow undervalued, or is, because of the whole energy transition and all the electric cars, that there is or was too little silver. And that was never really priced into the market. And that means you could actually position yourself very well here for years, ultimately, if you knew that. And that's how it is with commodity cycles. So there are also super cycles in oil. That's something we might be seeing right now, although it might not be definable as sustainable because of the whole Iran conflict and so on. If that subsides again now, it could perhaps go down even more significantly. Like a kind of spring, it built up quickly in its short time, so it didn't have a long sideways phase to really bring capital into the market, where banks and larger capital are simply reflected, since they tried to build up a sideways phase briefly and then really shoot upwards to simply cover a greater distance. In my opinion, we didn't have that now, but rather just a quick breakout in the end. That was more what was recognizable here. And that, of course, also applies to precious metals, and they also ultimately have a multi-year duration. And you can see that very well from the capex cycles too. And as we've already mentioned, there are, of course, always panic phases when quality is offered at clearance prices. So like in March 2020, timing is the strongest tool for above average entry prices. So if you know now, okay, the stock for whatever reason is at a low right now, but everything fits, we have a very good valuation. We have better order books. Let's just say the profit is going up, revenue is also going up, and the costs, however, they're even going down. Then it's usually very easy to recognize that, okay, you just have a very good stock here. As far as I know, it was even like that with Amazon, where the stock was beaten down so hard that nobody knew what was even there anymore. And Jeff Bezos even said, yes, he even checked everything. Everything was better, the profit, revenue, costs had gone down, so everything was in the right direction. And yet the stock was simply pummeled. And that's just it when you know that, okay, this is actually a gem right now. For a simple, really cheap value, it's also simple here. Maybe also where timing simply makes sense. Ultimately, you can just give this as a recommendation. I would just pick out the top picks from each sector, perhaps. So if you look at individual stocks and see which companies might have a nice moat and look, okay, where can I find a good entry price? Roughly where would I buy more? What do I personally find fair to pay, so to speak? And just write down a playbook, let's say, of say 20 stocks, but then also stick strictly to it. I mean, if it's maybe €1 or €2, or depending on the stock's value, if you happen to neglect or overlook €1 or €2, that's perfectly fine. You just have to follow a certain strategy and know why you're buying the stock. It's also kind of what we said at the beginning. If you know why you're buying this stock and for what purpose, and you're willing to pay the market price, why wouldn't you be willing, if the stock drops another €20, to buy it at a cheaper price now, if you were willing to pay a higher price before? And you have to keep that anchored in your mind a bit. I used to put it quite nicely somehow. I always compared it a bit to fashion when you go somewhere, say online shopping or even in a store. And then it says something like, I don't know, 40% off. Nobody asks, or very few do, why is it now 40% off? Instead, the thought is, oh, great, I saved 40%, I'll buy it. But if a quality stock drops 40%, people ask, why did it fall so much? Should I buy it now or should I not buy it now? Huh?
That's always the reverse psychology.
Yes, and I think if you remind yourself of that daily and think about it a bit, I think you have many stocks there. I don't know, Algotopo, how it is for you, but when I walk through the supermarket, right, it's almost a habit to always look at the back, okay, who's the manufacturer of this or that? And if you just do that and actually know what's in all the supermarkets and who the manufacturer behind it is, that's always interesting, or even, yeah, funny to see. So I go,
Although, with your analogy, if you take the supermarket again, there are many people, or the majority of people, who usually want to buy the most expensive product because they think the most expensive product has the best quality. So it's actually exactly what you're saying about the stock market in the end, too. If a stock is doing well, meaning it's expensive, then it's a high quality product. So everyone wants to buy and get in. Whereas if a stock is cheap, then everyone thinks, oh God, something's wrong with it, or it's just cheap junk. And then you shy away from it, even if it's a quality. So what's it called? It's a quality company that's actually doing quite well and isn't on the verge of bankruptcy. But it's just always this psychology behind it, which you can really compare quite well to shopping.
yeah, that's really interesting to see, isn't it? Or, well, there's also, I don't know, I think everyone knows Südzucker somehow. For me, that's basically the brand where if I say I'm going to buy sugar, then I see almost exclusively Südzucker everywhere. Sure, you also see the private labels of all the supermarket chains, but I mean, you also have to look at who produces for these supermarket chains anyway. And that usually leads back to almost the same company. I don't know about sugar specifically, but that's often the case, right? People should actually be aware of that by now. What else you can say is that timing on a macro and cycle level works. Timing on a daily or weekly basis, well, I wouldn't say it doesn't work exactly, but honestly, it's just a really high effort process, for example, that you simply have to put in if you want to keep up with it. And, it can be a bit much sometimes. Yeah, then you really have to dig in. I'd say to recognize a pattern on a 4 hour or daily level and say, okay, this is actually worth it to you now. I mean, really worth it. It's not for me because, well, you also want to have a bit of time. You don't want to spend it all in front of the screen. Of course, you can also, sure, you can set something up so that when a certain value is reached, please notify me and then I'll go long, so to speak, or buy after that. You can do all of that. It's all completely legitimate. In the end, everyone really has to know what works best for them at the end of the day.
Yeah, I wanted to touch on the word playbook again and having a strategy. I think that's another point I wanted to pick up on because it's just super important because everyone says, or I can imagine everyone always thinking, oh God, I'm not going to write a playbook now, or notes in general where I map out my strategy. Like, why should I go to all that trouble? Why should I write something down? But that's exactly the key point, just having a strategy and also writing it down so that it's simply clear, so that you don't, in stressful market situations, then just randomly, like by chance, do something that then deviates from this strategy. That's why it's important to really take notes on it, to write it down, so you can always see, okay, this is the strategy, this is how I originally wanted to do everything, so that you're always reminded of it and really stay true to this strategy. Because only if